An auditor's role in a merger and acquisition is very important. Any competent socioeconomic instrument must have a check to ensure conformity and fairness. An auditor serves as an agent to ensure that a company's financial and operational statements are what they say they are. This will ensure transparency between both parties in a merger or acquisition. For the purpose of this course, the role of an auditor in a merger or acquisition is divided into 3 stages: pre-merger or acquisition stage, integration stage, that is, at the merger or acquisition stage, and the post-merger or post-acquisition stage. In the pre-merger or acquisition stage, before the process can commence, an auditor or audit committee assigned to evaluate a company's affairs must ensure due diligence. Part of due diligence includes having a comprehensive understanding of the business and its operating environment. This understanding establishes a frame of reference in which the audit committee or auditor considers the scope of its charter, its agenda, education needs, advisory needs, and ultimately the exercise of its business judgment in assessing the information about the accounting and financial reporting. During the course of gathering and analyzing information, the auditor will become exposed to the norms and trends in the business environment. This knowledge will enable the auditor address areas where special consideration may be necessary. Following on this, the auditor will highlight a number of considerations for those involved in the transaction to note. For example, the current state of the industry the parties to the transaction work in. In this case, he or she will note the variables in the operating environment that can result in a change in competition and supply or demand and other financial risks. One other item to note is the rate of growth of the industry. Rapid or significant growth in the industry could highlight what is most appealing to the public at a given point in time. Finally, auditors may note new business models, products, or activities. Entering into industries, business areas, or transactions with which an entity has little experience may introduce new risks associated with financial reporting, and these must be noted. Auditors are very skilled professionals with the necessary expertise to analyze the financial statements of a company. Auditors are required to ensure that the financial statements or records presented to them by management are in agreement with the underlying books and records of the company. In addition, auditors ensure that the assets and liabilities stated in the company's financial statements and records are reasonably stated and actually belong to the company. Similarly, auditors ensure that the company has applied the generally accepted accounting standards in the preparation of their financial statements. Auditors also ensure that the company has consistently applied its accounting policies in the preparation of the financial statements, and if there are changes, that these are stated and quantified in terms of impact of such changes on the financial statements. Auditors express their opinions on the financial statements presented to them by management as to whether they show a true and fair view of the financial position of the company and of the profit or loss at a given period. The role of auditors also includes the fact that they detect any inaccuracies in the company's financial statements, and they are there to ensure that the financial statements and records match the productivity of the company. The financial report generated by an auditor is based on his evaluation of the company. The financial report should provide a clear picture of the company's financial circumstances. This is the information that investors will rely on when they want to make an informed investment decision. The integrity of the financial statement should not be compromised because it will have a direct effect on the price the investors are willing to pay for a company's securities. At the integration stage of a merger or acquisition, the auditor will focus on strategy development in preparation for when the merger is concluded. Once he has carried out due diligence, his main duty and responsibility at this level are the staff. This means he must develop a clear roadmap of the economic objectives that will drive the transaction and can be used to communicate the goals both internally and with advisors. The auditor will also provide information about the appropriate commercial, legal, tax, financial reporting, valuation, and regulatory skills that are needed to complete the transaction and involve the appropriate professionals early in the process. At the post-merger or post-acquisition stage, an auditor is obligated to help all parties involved acclimate to their new organizational structure. The auditor will evaluate the financial implications of the transactions and determine whether the transactions will affect any pre-existing credit or debt covenants and how the stakeholders will fare and any external factors that could affect the company. An auditor will conduct an evaluation of the company's management staff, senior level staff, and productivity of the different departments of the company. The auditor must inform the company directors to the risks to which they may be exposed if the company is not diligent in its post-acquisition management. He will also ensure that the internal audit should check the efficiency of the reporting systems, structures, and people. Internal audit ought to examine the usage of assets, compare outcomes with the original strategy, and identify opportunities to further integrate the facilities.